The fifth important takeaway from Howard Marks, quote, mastering the market cycle, is to understand tendencies. Dave, who has been investing in the stock market for a few years, wants to eventually live off his investment income and spend more time with loved ones. However, his timing in the market hasn't been optimal, and his portfolio took a hit in late 2018 due to the US-China trade war. Frustrated by the losses, he sold most of his stocks. Unfortunately, the market soon rebounded and reached new highs. Now Dave is investing again but feels unsure about whether to invest more or withdraw from the market. He worries about potential losses or a looming financial crisis without being able to predict them accurately. He desires the ability to determine whether the market is heading for a bull or bear market and take appropriate action. In other words, to master the market cycle. Fortunately, there is a way for Dave to navigate market swings more effectively. However, it's essential to examine his choice of words. In investing, no one can predict with certainty what will happen. Instead, it's possible to discuss what is more likely to happen, and that makes a significant difference. To illustrate this point, consider a scenario where Dave has the opportunity to participate in 3 different lotteries. The rules are the same for all 3. He pays $1,000 and draws 1 marble from a bag containing 10 marbles. Drawing a green marble results in a $3,000 payout. A yellow marble means he gets his money back, $1,000, and a red marble yields to nothing. Lottery A has an expected payoff of $500 per marble drawn. Lottery B is a zero-sum game, and a Lottery C has a $500 payoff. The correct choice would be to participate in Lottery A. However, it's important to note that even Dave identifies Lottery A as a superior option. There is no guarantee of making money. There is simply a tendency for it to be more profitable. It's possible for Dave to draw a red marble, although it is less likely. Therefore, understanding tendencies in the market is crucial. It helps Dave make informed decisions and increases the likelihood of favorable outcomes. The superior investor possesses the ability to discern stocks with a higher likelihood of yielding profits, which can be linked to identifying the contents of different bags of marbles. On the contrary, the mediocre investor simply chooses a bag randomly. However, there are instances when selecting a bag becomes relatively straightforward, such as when even stocks of mediocre companies are expected to generate substantial returns. Conversely, there are times when all bags should be avoided, even stocks of superior companies, as negative returns are anticipated. Dave must learn to recognize when the market tendencies are in favor or working against him. Introducing cycles. When Dave experienced a 20% decline in his portfolio in late 2018, only to recover more than in the following months, he witnessed the cyclical nature of the stock market. Upon reflection, he recalled a similar behavior observed in the past, where a friend of his father made millions in dot-com companies, only to lose it all in a subsequent market crash. He also remembered the boom in the new home ownership, which was later followed by concerns about a potential financial system collapse. The stock market is not the only system exhibiting this cyclicality. It can be observed in seasonality, weather patterns, various phenomena in physics, and even success in one's personal life. A cycle revolves around a secular trend, or a midpoint that can be considered reasonable. In the stock market, the secular trend is upward, driven by the underlying growth in business profits and dividends. Most cycles exhibit the following patterns: a reversion to the mean from an extreme low, a continuation past to the midpoint towards an extreme high, reaching a high, a conversion to the mean from an extreme high, a continuation past the midpoint towards an extreme low, reaching a low, and finally another reversion to the mean. It's important to note that these events are not merely sequential but also cause one another. The stock market resembles a pendulum, swinging between optimism, greed, and high prices to pessimism, fear, and low prices, and then back again. Greed and optimism cannot persist indefinitely. They eventually deviate from the secular trend. Stocks become excessively expensive relative to their earnings, and when investors become more risk averse, a crash or correction is likely to occur. Warren Buffett, widely regarded as one of the greatest investors of all time, summarizes the phenomenon by stating that what the wise do in the beginning, fools do in the end. Although the actual market behavior may not always align perfectly with the illustration, as Mark Twain said, history doesn't repeat itself, but it does rhyme. At extreme ends, most stocks resemble bags of marbles like these, while at low extreme lows, most resemble bags like these. Dave aims to learn how to identify these excessive highs and lows in the market cycle. But first, he must understand that the stock market is interconnected with their other factors. What influence the market cycle? The stock market's pattern of ups and downs, like other cyclical phenomena, is influenced by four major cycles: the economic cycle, the profit cycle, the credit cycle, and the psychology or attitude towards risk cycle. The economic cycle is measured by the gross domestic product of a country, which is the result of multiplying the number of hours worked by productivity per hour. Dave should pay attention to deviations from the GDP's historical growth rate of about 2% per year over the past decade, as these swings are caused by demographic movements, the unemployment rate, globalization, and other factors. The profit cycle plays a crucial role in determining stock prices, as business profits are a key component. Dave is familiar with the price-earnings ratio, a commonly used indicator to assess whether prices are high or low. While total sales of all companies in a country are equivalent to the country's GDP, profits fluctuate more due to operational and financial leverage. The credit cycle is vital because companies rely on credit growth and to fulfill their old obligations. Access to new debt affects companies' abilities to meet their obligations, and a lack of credit can lead to defaults. Interestingly, many individuals and companies don't plan to repay their debts, which can create challenges when credit doors close. During certain periods, prosperity leads to expanded lending, unwise lending, significant losses, a halt in lending, and ultimately a decline in prosperity, according to Howard Marks. The psychology attitude towards risk cycle heavily influences stock market swings. Investor psychology is a primary driver of market fluctuations. During periods of euphoria, the financial community becomes risk tolerant and overlooks negative news. Conversely, during periods of depression, investors become risk averse and anticipate catastrophic outcomes. Assessing the current attitude towards risk is essential for Dave to determine the position of the market cycle. Thus, the stock market cycle is influenced by these four major cycles: economic, profit, credit, and psychology attitude towards risk. These factors interact and contribute to the market's fluctuations. Taking the temperature of the market. To demonstrate where we stand in the market cycle, Dave should follow two key steps. First, he needs to assess the valuations of the stock market and compare them to historical data. This step is essential because there is no significant deviations. It indicates that the market is not excessively high or low. In such cases, the second step is unnecessary. The second step involves becoming aware of the investing community's sentiments and behavior. behavior. Dave should pay attention to how others investors perceive risk. By observing these factors, Dave gains insights into the current state of the market cycle. Next, he examines a table that presents different pairs of statements describing the current market. Dave checks the column that the best describes the market's characteristics based on his judgments. If the majority of his checks aligned with the left-hand column, it suggests an excessively high market, and vice versa. These assessments are subjective and non-quantifiable, which is advantageous as it allows for profitable identifications of highs and lows. An important insight is that if Dave doesn't need to make forecasts or rely on future predictions, his observations of the present state of market are sufficient. Now that Dave understands how to identify highs and lows, it's time to learn how to respond appropriately to this information. Aggressiveness versus defensiveness. The graph illustrates the typical expected returns of the stock market. If Dave believes that the market is currently at an excessively low point, he may choose to adopt a more aggressive portfolio approach. This involves taking on more risk with his capital, holding lower quality companies, investing in opportunities highly dependent on a favorable macroeconomic outcome, utilizing financial leverage. By adopting an aggressive portfolio, Dave increases the likelihood of both highly profitable swings and potentially costly swings. Fortunately, with his ability to assess the market cycle, he can be reasonably assured of positive outcomes. The difference between the two curves represent additional gains Dave can achieve by favoring an aggressive strategy instead of a passive one. Let us know what you think in the comment section below. Like and subscribe. See you on the next one.